All right, welcome. This is our week 3 economics video. This will be our quickest one. Really, this time I focused only on things that I have been asked about by students. The other things I'm assigning for the week will also be going into similar topic, but much greater depth. I'm going to try to keep this as quick and simple as possible and just go over some of the key terms because the Khan Academy that I'm posting will have a lot about how to actually make determinations about things like your interest rates. So let's look at interest rates. I know this slide has been on the prior presentation, but I just wanted to go back into the idea that yes, interest rates are determined by the federal government in many instances, and that our Federal Reserve makes those calls based on our overall economy, raising the interest rates or having a tight monetary policy in order to make sure that inflation doesn't get out of hand, trying to make sure less money is going to the hands of people to be spent and then reduce the amount of money that there actually is. That discount rate, I guess I forgot to mention that word earlier, is just the term for how much interest is actually there. So if you're going to lower interest rates, if the Federal Reserve lowers the interest rates or has an easy or loose monetary policy, it tries to put more money into the hands of people so they can spend it. And here I've added another thing. What is stimulus? Anyway, stimulus has nothing to do with our interest rates, but since we're having stimulus checks go out right now, this happens. It's happened a few times in the past 2 decades, but as a way of trying to put money into the hands of people to stimulate our economy, to get people spending money. So obviously right now with our stay-at-home order, as many jobs have been furloughed, it makes sense for the government to put out a stimulus check so people have money and spend that money. Spending money helps our economy. So those interest rates, of course, can be used to look at our student loan stuff, as we're going to look at that because, or even any type of bank loan. But student loans, the interest rate, whenever our economy started doing better about 3 years ago, 4 years ago, interest rates crept up. So the banks, as I said, the Federal Reserve is like the bank of our federal government for the entire United States that's going to make a lot of decisions based on things like jumping back interest rates for all the banks to adhere to whenever they put out a loan. They also determine how much money actually has to be on hand at each bank. Once again, going with that tight or loose monetary policy. The FDIC, the Federal Depositors Insurance Corporation, actually insures your money that's in the bank. So let's say the economy started really going downhill and everyone got scared and they went to the bank and started pulling out all the money they had. Well, the FDIC is there to make sure that that money doesn't go away, doesn't cause that panic, doesn't cause banks to go out of business anyway. So if you have $250,000 in the bank, the federal government's going to pay you back for that if it somehow got lost. So the FDIC backs every legitimate banking entity. Different types of banks. We have savings banks, we have just regular old banks, and we have credit unions. Really, we'll just call this banks, private banks, and credit unions as our 2 separate things to really look at ourselves. And that's where a bank is if you go to the Bank of America or Wells Fargo or whatever. Who owns that bank? Well, they're shareholders. And their goal is to make sure that money goes into the hands of those shareholders. In the recession in 2008, we did see those banks getting bailed out by the federal government because they are in control of much of the money and loans for the entire United States for most citizens. There's also credit unions. Credit unions are not owned by many people in a corporation. They're owned by every member of the bank. So each bank has its own benefits. If you're to take out an auto loan or a mortgage, sometimes you get a better rate with your credit union or with your normal bank. Sometimes you do with the credit union. It really depends. You have to look and see what the rates are at various times. But when it comes to loans and the like and collecting interest, you might do better saving at a credit union than you would at a regular bank because they want to benefit the shareholders in both of them, whether that is the people who run the bank or the people who own the stocks or shares of stock really matters. But it's just ownership for the bank and the credit union. How do you bank with a credit union? Typically, they're going to be applied to a type of job or something along those lines. State employees credit union SECU is our big one around here, and you have to be someone who works for the state government or has a family member who works for the state government to get you in there. Different things that our banks offer, different services, deposits. You can deposit your money in there. If you have a savings account with your deposit, that savings account will accrue interest and make money on that which is being saved there. That also goes to that tight or loose monetary policy. In a tight policy, whenever the interest rates are high, you make money. You make more money with that high interest rate. Checking accounts, you don't make money on that. Your money goes in, but this is money that can be easily spent. Loans, sorry. I need to pause this. Sorry about that. If you heard a dog barking, it's because one of our dogs saw another dog outside. Where was I? I believe I was on loans. Loans, when you request money for typically a mortgage or a car or something along those lines, that's money you borrow from the bank. But when you borrow that money, you pay it back with interest, similar to when you save your money in a deposit account and you receive money from interest. You pay back interest on that, and that's kind of like rent on the money that you borrowed. Typically, it's going to be paid through compound interest, which we'll get into a little bit later. But also, if you can't pay that loan back, there is collateral. In the instance of a mortgage, that would be the house that the mortgage is on. In an auto loan, it's that car. Now, some loans, like student loans, don't really have any collateral tied to them, and therefore it makes them difficult to get rid of if you cannot pay them. Credit rating. I've got another slide that I threw at the end of the PowerPoint, which we'll get to, but your credit rating really determines how much money you will spend over the lifespan of a loan through different interest rates. If you have a high credit rating, you qualify to be able to borrow more money because they trust you to be able to pay that back. Additionally, you'll have a lower interest rate, and those can become really, when we look closer at loans, a small change in interest rate with a compound loan really does make a huge difference as to how much you pay back over time. So if you have a better credit rating, you don't spend as much money. But we'll get to that here in a couple of slides. This one right here. Your credit score is determined by FICO, which was originally the Fair Isaac and Company Corporation, but it's an independent company that looks through different factors of your payment. There's a score between 300 and 850. If you have a score around 300, you do not have a good credit rating. If it goes up towards 850, that'd be the perfect score, and that is incredibly difficult to make happen. But they're determined based on several things. 35% of it is payment history. So if you pay all of your bills on time, that's only 35% of your credit score. There's also what your current loan and credit card debt is. 30% of your credit score is based on this. How much do you owe? Have you been paying it back in that credit payment history? What's the length of that credit history? 15% of your credit score just based on how long you've had a credit history. So when you hear about debt and you think debt's not a good thing, debt really is a good thing. It's just that you have to keep up with it. Keep a good debt to income ratio. Types of credit: mortgage, car loans, student loans, credit card debt. These are all things that factor in. You want to have a diversified manner and not like a whole bunch in credit cards. And then also 10% is new credit. Now, new credit can either be good or bad. It really depends. Could it be you upped your limit on something? Maybe you've paid off so long or had a nice long-term loan with a credit card company or and you've increased that credit. That would be a positive thing for your credit score. Trying to just take out a whole bunch of credit cards at once to develop new credit does not bode well for your credit score. But there's a number of different factors. And as I said earlier, why does it matter? Well, if you have a good credit rating, that in the 800s or so, you're going to have a much lower interest rate. And as compounding happens, the difference in like a 6% loan and a 7% loan is significant. When we look at credit cards, the difference between a 17% interest rate and a 22% interest rate, or even a 30% interest rate, is significant. When you look at the Khan Academy videos, hopefully you'll watch those, you'll see, and then even on the assignment that I've given, the worksheet, that like over the course of, really depending on the credit score, the interest rate, how long it takes before you're paying double what you took out, because it is almost inevitable that through the life of a loan, with this compounding interest, that eventually it will double. So when you hear something like, oh, it's 9% loan, that doesn't mean you're adding 9% to something. That means 9% compounded, which typically means that over the course of something like 8 years, you're actually doubling the amount you took out to begin with. Speaking of that time period, when we look at like 15 years, 20 years, 25 years, if we're thinking about student loans, something you're coming up on very soon, there's two basic types, federal and private. Federal, meaning from like the Department of Education or Federal Stafford loan, these are from the federal government. They're going to have typically a lower interest rate than your private companies will. However, only a certain amount of loans actually are offered through the federal government, typically based on your income level, your family's taxes. But the private ones will typically offer you loans in the tens of thousands of dollars beyond those federal loans, but their interest rates are at least double many times what the federal government's interest rate is. I believe the current federal interest rate is about 6.4%. I might be wrong on that. You can look it up online, where when I finished school, it was like 3%. Private loans, some of them are like 12%, and that is very significant. When we look at the federal government's interest rates, there's subsidized and unsubsidized loans. We've talked about subsidies before, something where the government is actually paying for something. And in this means it's the interest rate while you're in school. A subsidized loan, the federal government is actually paying that interest rate that you have the whole time you're in school. You're not actually paying anything from the moment you start school until you graduate. And then after that grace period, which will be on the next slide, then you start paying that and interest starts accruing. Now, in an unsubsidized loan, which the federal government also does offer, the federal government's interest rates are, of course, much better than private loans. No private loans are subsidized. They're all unsubsidized, meaning that the day you take that loan out, it starts accruing interest. So as soon as the money is dispersed, interest starts building at a compound rate, meaning that by the time you graduate from college, you may owe way more money than you ever took out. So here's some terms that we need to know when we're looking at student loans. Cosigner. Most of you don't have credit, therefore your parents will have to co-sign on this loan. That means that your parent is also responsible for this loan. So if you take out $50,000 to go to art school, your parents are going to be helping you pay that back. And if you decide that you can't pay it, that's going to impact their credit rating, and they will be on the hook to pay for it. Now, speaking of not paying for it, this word default. You may see that occasionally, especially as you talk to your financial advisor at your colleges. They tell you, make sure that you do not default. Defaulting means that you've not paid your student loans for a long period of time, typically several months. And that means that, sorry, the dog is jumping on me. That means that your balance of your loan, once you've defaulted, not paid it for several consecutive months, the loan is then due in full, the entire amount, not just the monthly payment. Once a loan is defaulted, now that can cause all sorts of problems, like where the government may garnish your wages, taking money from you. It will destroy a credit score, making it difficult to take out other loans. Any federal tax return refunds might be confiscated and sent to the student loan servicer. So just make sure you pay your student loans. And if you can't pay your student loans, try to defer or forbear that. Now, deferment and forbearance both mean the same thing. That's really putting off your student loans payment for a little while. You have to request this. And federal loans, the federal government will allow a deferment or a forbearance period. where private loans may not do that. Now, there is one definite way that private loans do end up being deferred, and that's if you go back to school or join the military. Those do not have to be paid back. Currently, because of this COVID-19 stay-at-home thing, the federal government has made every single one of the federal student loans in a period of forbearance where no one is paying those unless they wish to pay down that interest rate that's accruing. A grace period is that period after you graduate college, but before those loans are due. Typically 6 months, I believe. Grants, you may get some grants, similar to scholarships. Scholarships you had to qualify for, but you may get grants just based on your financial status from your college. Grants are free money. They are not loans. You do not pay back a grant. Thinking of loans, though, interest-based repayment, federal government offers these. Many teachers will fill these out, and they'll pay only based on what they can, based on their income. The federal government looks at that. Interest, which we're going to look at, APR, annual percentage rate. This is that percentage. If you see a 9% APR for a private student loan or a 6% APR for a federal student loan, this means that this interest that you owe will end up being capitalized, or compounded rather. Compounded typically a couple of times a month, and it takes that interest and adds it to the principal, the amount that's taken out. That principal balance is the amount that you borrowed plus the interest, and then new interest is accrued on that, and that's compounding, adding it, capitalizing it, adding it to it. So your interest will add up to this APR. The Khan Academy video explains it much better, as does, I believe, the video I posted about interest as well on the Ed puzzle. But principal balance, as I said, money you take out plus the interest itself. Public student loan forgiveness. If you're a public servant, teacher, healthcare worker, you can apply for public student loan forgiveness. If you look at the federal government's student loan website, it will tell you about this, and you very well may be qualified to have some of your student loans forgiven, meaning you don't have to pay it back if you are willing to work in a certain field at a certain level of money for a given period of time. I believe teachers are 5 years of teaching in a low-income school, and you can have part of your debt paid off. For those who teach science or math, engineering, it's something like $16,000 is forgiven. For people like history teachers or English teachers or art teachers, it's something like $2,000 or $3,000. So servicer, I mentioned that earlier. That just means who you pay your loans to. I pay mine to Navient every month, which is a rebranding of Sally Mae, but that is the one who handles most loans. Sometimes banks will, especially if you look into the private student loan sector, but these are just some terms to know. If you have questions about student loans, I'll try to answer them. These are just the things I came up with off the top of my head when thinking about how can I tell you some of the terms about student loans. Anyways, hope to hear from you soon. I hope that helped a little bit. Take a look at those Khan Academy videos, take a look at the Ed puzzle, and feel free to ask any questions you have, and I will try my best to help you. All right, I hope you have a great week. Thank you.